Did you know the insurance business is one of the main reasons as to why Berkshire Hathaway compounded like my plate at a Chinese all-you-can-eat buffet? Dude, that's one of the things I miss the most about living in the US. Here in Japan, there's no such thing as an all-you-can-eat buffet. And if there is, it's very far and few and very rare. If you turn your eyes to your screen right now, we're looking at the total return for the adjusted stock price of Berkshire Hathaway. And it's the parent company of a bunch of different businesses, led by Warren Buffett. Now, year to date, they're only up by 5.6%. And I say only because in the past 3 months, they're down by negative 7.5%. Now, I think it's because there's a lot of uncertainty surrounding the future of this company with Warren Buffett stepping down at the end of the year, even though he already named his successor in Greg Abel, and he's the one that's been running the company for like the past 3 to 5 years anyways. Do you really think a 95-year-old is the one that's making all of the executive decision making at the board meetings and whatnot? No. Okay, it's been Greg Abel. I think this company is going to be okay, but because of that CEO transition, Berkshire Hathaway is being sold off. Another company that is being sold off because of a CEO transition is Hershey Company. My goodness. The Hershey Company is a dividend compounder with cheese, and right now they're going into that discounted bargain price where I might even dollar cost average. But anyways, if we zoom out and take a look at Berkshire Hathaway's performance in the stock market, it's nothing short of handsome, beautiful, and cute. Because past 5 years, 167%. If we do 10 years, 246%. And if we want to include the great financial recession of 2008 to 2009, we zoom out to 20 years, 743%. Your money invested into Berkshire Hathaway in 20 years, what a 7x. Friends and family, that's the definition of a compounder. They're not a dividend compounder with cheese because they don't pay a dividend. You see, Warren Buffett is a hypocrite. He's one of those people where it's like, do as I say, but not as I do, because his own company does not pay a dividend. Whereas he would never invest into a company that doesn't pay a dividend. And his reasoning is this: we can use the retained earnings to grow the business to return more shareholder value to you guys in the stock market performance rather than just giving you a dividend. And I think he is good on his part. And if we zoom down to look at their CAGR, the compound annual growth rate, how much your money would have grown year over year, Berkshire Hathaway the past 20 years is 11.2%, and the S&P 500, also known as the market, that's the benchmark that everybody is trying to beat, was 10.5% in the exact same time period. So the Bob Ross picture that I'm trying to paint here today is that Berkshire Hathaway's success, a huge part of it, is because of the insurance businesses that were under the Berkshire Hathaway umbrella. The insurance business model is steady and it's a reliable revenue generator. So in this video, I'm going to be talking about why I think the insurance business stocks are some of the best pound for pound investments that we can invest into as amateur investors. Are you ready? Let's go ahead and get into it. If we're going to be completely transparent with one another, yes, the health insurance industry in the US, they're in a pickle. All right, but this video is talking about the other side of the insurance business, like property insurance, pet insurance, auto insurance, that sector. And insurance, at the end of the day, at least here in the US, it's mandatory. It's required for a lot of the stuff that we own or do. If you want to drive a car, it's mandatory that you have car insurance. If not, you have to pay a huge penalty fee if you get caught driving without insurance. If you want to rent in an apartment or a condo, you need renter's insurance. So it's a business model that is always going to be in demand. However, I will say this, the insurance business model is absolutely not as sexy as Nvidia or Microsoft because they're not really at the pioneer or the head front of the AI movement. Even though they might incorporate some AI technology, it's not exactly changing the trajectory of humanity and how we do economics and work itself. But even though it's not a sexy industry, I still think it's a solid investment in the stock market. So what exactly is the insurance business model? Individuals, companies, or particular specific groups, they will pay you money up front on a monthly basis, and that is known as the premium, so that the insurance company can carry out services, also known as claims, that may or may not be utilized in the future. If you get into a car accident, your car insurance is going to help you cover the bills. However, before that happens, you have to pay your premiums month over month, year over year. So after the insurance company collects this money, what happens next? The insurance companies will pull this money into their float. That's a very important keyword that you have to understand when it comes to insurance companies. And the best part is they're going to use this float to generate more money. It doesn't just sit under your pillow, just cash. No. The insurance companies will use that money to invest into a high yield savings account, certificate of deposits, CDs, a money market fund, anything that's really high liquidity, but also a guaranteed safe way to grow your money. So they're using their float to grow their money. And the best way that I can describe it is, you think of it as like a college or a university's endowment fund. Whenever alumni donate money to that school, it goes into the endowment fund and it just keeps growing and growing and growing. And then obviously the school can use the endowment fund to how they see fit, to build a new football stadium, to restructure, to renovate the library, to give out scholarship and financial aid, whatever. That's kind of like the float when it comes to an insurance business. All that to say, that should be the biggest takeaway from this video. Cash by itself, if you just put it into a checking account, it will not and cannot grow. But what I'm trying to say is that cash can make more cash on your behalf through dividend stocks, real estate investing, or from a high yield savings account. Don't just let cash sit by itself. You might be rolling your eyes because it's a really simple concept that a lot of people ignore. And believe me when I say that, coming from a guy that used to only use cash for every transaction. There was a point in time in my life where my risk tolerance was so high and I was so ignorant that I didn't know how to utilize credit cards, invest into stocks, and everything else in the personal finance realm because I didn't have a father figure to teach me the ropes. And that's why I'm such a huge advocate of dividend growth investing and having your money work for you and all that jazz. Use your money to make money. That's it. Okay, so getting back to the video, talking about insurance stocks. So check this out. The float. Berkshire Hathaway's insurance float in 1979 was $39 million. For back then, that's pretty darn high. However, throughout the decades, that float was able to compound upon itself, plus with the premiums that are pouring in month over month from all the different customers and clients. In 2025, their insurance float, Berkshire Hathaway, is now $173 billion. Guys, that is absolutely ludicrous. That's insane. But one thing that we do have to keep in mind is that the float cannot and will not grow if the business itself is covering and is insuring something that is just way too risky. Because if it's a risky industry or client base or region, then there's going to be too many claims which result in too many payouts. For instance, if it's an auto insurance company that is primarily operating in the Midwest to the East Coast, and a lot of your customer base drives Kias or Toyotas or Hondas, that's going to be a very painful business strategy because of the Kia boys. I remember during the pandemic, there was a growing movement of people posting on social media of how easy it is to steal a car. And so there was a lot of young kids that were impressionable and wanted to do it for clout and record themselves stealing cars and just crashing it for fun. Dude, it seemed like almost every single day, Kias, Hondas, and Toyotas are being stolen for fun and being posted on social media for the world to see. And I'm not trying to come off too judgmental, but that was such a stupid thing to be trending and to be a fad. So when it comes to the insurance industry, the float is contingent upon who you are covering, but also the underwriting strategy. And I got you, don't worry. You don't have to pause this video to look up what an underwriting strategy is, because I'm about to explain it to you. So when you apply for an insurance, it doesn't matter what type or style it is, whether it's for your car, home, health, or life. An insurance company's underwriting team, whether it's a person or AI, it seems like this can be done with AI these days, they evaluate how likely you are based on who you are and where you live and what you own, how likely you are to file a claim and how expensive those potential claims are going to be. They play out all of these different hypothetical scenarios like, oh, Mr. Johnson, 56 years old, dude, he drives a 50-year-old pickup truck and he gets a speeding ticket every other week. your insurance premium is going to be a lot higher. And if you're considered too much of a risk, this company might not even offer you insurance at all. They might just deny or reject you. So the higher the perceived risk, generally the higher the premium is going to be. That way the insurance company can balance their risk to reward just in case you make too many claims. Basically, everything that we just said can be summed up as the insurance industry is a very boring business model, but it does in fact print cash. It's easy to understand, and for the most part, they have good financials. So you might be asking yourself the question, then what's the catch? It sounds too good to be true. And that's a really good question, because I think it depends on the industry that you are insuring. Because I guess the catch is this. When you think about it, with natural disasters, such as recently, right, the Central Texas flood, or in the beginning of this year, the California wildfires that took out a bunch of homes in Los Angeles, for the insurance companies that covered those properties, their profitability and their bottom line took a major hit because they did in fact have to pay out to all of the claims of their customers. But I think the insurance companies in the future are going to be one step ahead, because I think it's just going to result in higher premiums for those riskier areas or industries. Like if you want to get a homeowner's insurance in Tampa Bay or Miami in Florida, I am positive that your homeowner's insurance is going to be 2 to 3 times higher than somebody who lives in, I don't know, in the middle of nowhere, Illinois. Although I think in the Midwest, they also have to worry about tornadoes. I feel like every corner of the United States has something they have to worry about. I think California has the wildfires and earthquakes. Washington State, we've got a sleeping volcano that might erupt at any second. And then you've got the hurricanes and the coastal regions in the south. It's just pick your poison. Now, with all of that said, let's go ahead and do a working example with Berkshire Hathaway. We're going to take a deeper look at their numbers. Type it in right here, and I'm just gonna pull up, let's see, Berkshire Hathaway. And there's 2 different classes of stocks. We're just gonna go with Berkshire Hathaway Class A shares that give you voting rights. Let me just make the screen a little bit more digestible, so that way you guys can see better. So Berkshire Hathaway, as I alluded to, is a conglomerate, a diversified portfolio of a whole bunch of different businesses. And in fact, it's the parent company of my favorite running shoe brand, Brooks. By the way, if you're on your feet all freaking day because you work at a fulfillment center, or you work in healthcare, or you do Amazon delivery, Brooks running shoes is the answer. I'm telling you, dude, it's so much better. I think Brooks is number 1, and then right below it would be New Balance and Saucony. I think Hoka Ona Onas just don't work for me because the foam on those shoes are so freaking soft that if I stand for more than 30 minutes, they start to get sore. I need the foam on the soles to be a lot more firm. And that's what Brooks, Saucony, and New Balance provides. At least it does for me. But Berkshire Hathaway is also the parent company to over a dozen different insurance business segments. Number 1, Geico. I think everybody recognizes that little gecko with the car insurance company, Geico. They do General Re, which, by the way, this is a different segment of the insurance sector. They provide reinsurance. Because when you think about it, if it's only one insurance company that was responsible to cover and pay out for all of the houses that burned down in California, their financial burden would be too much and they would go belly up. Consequently, in the insurance space, there's insurance companies that insure the insurance companies. Does that make sense? So reinsurance is insurance for the other insurance companies so that they can transfer a portion of the financial risk and burden in case there's an earthquake or a catastrophe that takes out an entire zip code and there's thousands of claims where each one is going to be like $2, $3, $4, $5 million. So it spreads the insurance risk from just one hand to now 2 hands. And then you get another reinsurer, and now there's 3 people that are going to be paying out for those houses in case something goes wrong. And Berkshire Hathaway also owns the National Indemnity Company, Allegheny Corporation, and the Berkshire Hathaway Life Insurance Company of Nebraska, just to name a handful. And if we take a look at their numbers, right, I am not joking when I say the insurance business model is absolutely ridiculous and it's slept on. I think too many people out here talk about Google, Microsoft, or even Big Bear AI. But I think the insurance companies are like getting a 7th round draft pick for the NFL turns out to be a hidden gem like Brock purdy. That's what I think of when I think of the insurance companies. But let's take a look at their financials. I'm on the income statement, which, by the way, I made a video breaking down how to analyze and read the financial statements like an investor for the income statement and the balance sheet. And I'm currently working on the cash flow statement one. Please go watch those videos if you haven't already. So if we take a look at their income statement and we take a look at their revenue, their top line, just look at the growth. This is absolutely disgusting in a good way, in a pretty way. It's going from 2015. They used to generate $200 billion. That's pretty darn respectable. This is not Microsoft. This is not NVIDIA. This is Berkshire Hathaway. And as you fast forward throughout the years, I mean, obviously the pandemic is an outlier year where almost every business was struggling. But as we fast forward throughout the years, just look at this consistency. In the trailing 12 months, another way of saying the past 1 year, now they generated $371 billion of revenue. That's just the top line, friends and family. Because if we scroll down to take a look at their net income, this is what investors refer to as the bottom line. What are the profits after paying for all of the expenses to run and operate that business? Friends and family, it's $80 billion of leftover money. And if you break it down to a share level, take a look at this. Their earnings per share is $56,000. That is ridiculous. This is the definition of a company that needs to do a stock split. I mean, who in the world will wake up one day and say, honey, I think I'm going to buy 1 share of Berkshire Hathaway Class A shares for $700,000. That doesn't make any sense. And that's why they have another category known as the Berkshire Hathaway B-Class shares, a lot more affordable and reasonable at just under $480 a share. And on an unrelated note, the other day I buzzed my head with a 0 on the sides and a 1 on the top, and look how much it's grown already. Pretty wild, right? And I think it's getting to that point where it's grown out and it's gonna start looking awkward here in a little bit. So I know, I do need a haircut. And speaking of which, dude, I watched a clip the other day of Kirk Cousins. Yes, the NFL quarterback for the Atlanta Falcons. Dude, he goes to great clips to get a haircut. A multi-million-dollar NFL player pays $20 for his haircut. I think that's pretty admirable, but also it's kind of hilarious because there's other NFL players that pay like grand for each haircut that they get from their stylist. Obviously, the barber is ripping them off, but the point that I'm trying to make is about 75% of all NFL players, once they wash out of the league at like age 25 or 26, they blow through all of the cash that they made, whether it was a $20 million contract or even like a rookie $600,000 contract, they blow through all of it and they become bankrupt. And I think that's kind of crazy. Because I think for most of us, if we were to make $1, $2, $3, or even $5 million in a year, that would be life-changing money. And we would know to buy SCHC, Microsoft, Google, Amazon, and to call it a day, and you would be set up for the rest of your life. But for NFL players, it seems like a lot of them gravitate towards buying really flashy cars, jewelry, and stuff that depreciates, and they just blow through all of their wealth. And I think that's kind of sad because it shows you that financial education and personal finance is a topic that needs to be more communicated to these players who go from making nothing to becoming a multi-millionaire overnight. Well, not anymore, because now we live in the NIL era where they make at least like $80,000 or $200,000 while playing in college sports. But I think the point still stands. When you go from nothing to millions of dollars, it should at least come with a brochure that breaks down of how you should spend your money so that you can at least sustain your wealth for life after playing sports professionally. And I think between you and me, that would be my dream job. If I could just help 1 or 2 players and become some sort of fund manager for them in order to help their $10 million grow into $15 million in the next like 5 to 10 years by investing into dividend compounders, I think that would be the dream job. I don't know. Because I think for the most part, almost every player in the NFL and NBA, they do have an agent, but I think they do more of the negotiating for their compensation and salary, but I don't think they're responsible for teaching them how to use their money, like how to save and invest. Because the ones that do become bankrupt, yeah, they had agents as well. So I don't know what this dream job title would be, but I don't know. I could live in the clouds with that one. But coming back down to earth and looking at Berkshire Hathaway, take a look at their balance sheet. Okay, this is going to be absolutely ridiculous, okay? So as of right now, Berkshire Hathaway, they have $347 billion of cash and cash equivalents. What is cash equivalents? Money that's invested into CDs, the money market fund, any source of income that they could liquidate in less than like 2 or 4 hours. $347 billion of cash and cash equivalents. Guys, that is just absolutely crazy. And I think it's a preview of how beautiful and cash heavy the insurance industry is. Now, why did I just say preview? Because I just spent the past 4 days doing a deep dive and researching the insurance industry. I looked into every single publicly traded insurance stock, the big players, the smaller names, and I analyzed 16 of them to figure out which ones are truly high quality. And the best part is, none of them have been covered on the channel yet. So every single one of the stocks is going to be fresh information. Now here's the deal. If this video hits 200 likes, I'm a man of my word, I will drop the full ranking with my personal buy price attached to the best ones. Or on the other hand, if 3 people join any membership tier of the Patreon, I'll release that video early. The full breakdown, analysis, and intrinsic valuations with my personal buy price attached. Whichever happens first, man of my word, 200 likes or 3 new people joining the Patreon. It's totally up to you guys. And honestly, between you and me, I feel like the ranking videos that I make are some of my best work. And it's pretty evident, right, how much research and how much effort I put into them. I'm talking about the BDC ranking video. I'm talking about the food CPG stocks video, the bank stocks ranking video, and that's just to name a few. All of them are available here on YouTube for free. And if you've watched any of them before, then you know it's well worth your time. Yes, some of them might be like an hour or an hour and a half, but it's so thorough that it's worth your time because you walk away feeling like you understand the entire landscape, industry, and you know which ones are worthy of going onto your watch list. So I'll leave you with this. If you want to see the full ranking and breakdown of the insurance industry, just hit that like button. That's all. It's free. Or if you're feeling generous, join us over on the Patreon. There is exclusive content on there that never makes its way onto YouTube. And you can watch that video before everybody else. Anyways, I love you guys. Stay safe. Good luck in the stock market, and I will talk to you next time. Peace.